If you missed Nvidia, if you missed Palantir, stop scrolling and actually listen to this one. Because what I'm about to walk you through isn't a stock tip and it's not hype, it's a bottleneck. A real physical, can't fake it, can't code your way around it, bottleneck. And in every single market cycle I've ever lived through, the money eventually goes to whoever controls the bottleneck, not whoever's got the flashiest product. Every person buying an AI chip right now, every company building one of these giant data centers, every government throwing money at this thing, they all run into the exact same wall eventually. It's not chips, it's not software, it's electricity, plain, boring, unglamorous electricity. The same stuff that powers your toaster. And right now there isn't enough of it. Not close, not even in the same zip code is enough. I've sat through a few of these cycles now, made money on some, lost my shirt on others, and this is the setup that actually made Nvidia what it is in the first place. Almost nobody is positioned for what comes next, and I think this is the most obvious trade sitting right in front of us, and people are still walking straight past it. Before I go any further, let me be straight with you. What I'm about to walk you through took me weeks of actually digging through this stuff to understand properly, reading things I had no business being interested in a year ago. And I'm going to hand you the short version right now. This is the kind of thing that if you get in early and you're patient enough to sit with it, can genuinely change what your portfolio looks like 5 years down the road. I'm not going to string this out over 3 separate videos just to keep you coming back. I'm giving you the whole thing today. All I'm asking in return is you hit subscribe before we keep going, because I put ideas like this out before they're obvious to everybody else. And I'd rather you hear from me first than stumble onto it after it's already played out and everyone's talking about it. So let's start with what everybody already knows, because you need this part before the rest of it clicks. Nvidia became the biggest story in this market because it makes the chips that train and run AI models. Everybody and their cousin figured that out eventually. That's just how these things go. The obvious trade gets obvious to more and more people until it's not really a secret anymore. Palantir became the second biggest story because it sells the software that turns AI into something governments and big companies will actually cut a check for. Both of those trades worked. Both of those are real businesses with real revenue, not some story stock running on vibes and a good investor deck. I'm not up here telling you either one is a bad company, because they're not. I'm telling you something different. I'm telling you the chip is not the hard part anymore. It used to be, it isn't now. I've made this mistake myself more than once. Early in my career, you find a trend that's real. You get excited about the most obvious, most talked about way to play it, and you completely miss the boring layer. Underneath that actually has to work first. It's a pattern that shows up over and over in every technology cycle, not just this one. When the internet took off, everybody wanted to own the flashy websites and the search engines. Far fewer people were paying attention to the companies laying fiber optic cable in the ground, and yet some of those infrastructure businesses ended up being enormously profitable once the dust settled, because the flashy stuff couldn't exist without them. I think we're in almost the exact same moment right now with AI, except this time the cable in the ground is a power line, and most people still aren't looking at it. Here's what I mean. A year or two ago, the constraint on building AI was, can you get enough of the right chips? That's it. That's why Nvidia's stock did what it did. Everybody was fighting over the same limited supply of GPUs, and whoever had them could build faster than whoever didn't. That was a real, genuine bottleneck, and the market priced it in hard. But bottlenecks move. They don't sit still. And what's happened over the last year, quietly, without a flashy keynote or a press conference, is that the bottleneck moved from the chip to the wall socket. You can have all the GPUs in the world sitting in a warehouse right now, and it does not matter one bit if you cannot get enough electricity delivered to the building they sit in. And that, right now, today, is exactly the position most of the biggest tech companies on Earth are in. I want you to think about what one of these new AI data centers actually needs. We're not talking about the kind of data center that ran your email or hosted a website 10 years ago. A single modern AI campus can need as much power as an entire small city, not an office park, a city. And it's not just one of these being built. There are dozens of them in the pipeline right now across multiple states, all competing for the same limited pool of available power. And multiply that by the number of these things being planned across the country right now. And you start to understand why utility companies, the boring, sleepy, dividend-paying utility companies your grandfather owned, are suddenly some of the most important businesses in the entire AI story. Companies are now signing contracts to guarantee themselves electricity years in advance, sometimes locking in supply before the building itself is even finished. Some of them are going around the public grid entirely and building their own private power plants right next to the data center, just so they're not stuck waiting in line behind everybody else. That is not a normal thing for a tech company to be doing. When Microsoft and Meta and Google start acting like power companies, signing power purchase agreements, restarting old plants, funding new generation directly out of their own balance sheets, that tells you the real constraint isn't code anymore, it's electrons. I've sat across the table from enough founders and enough operators to know that when a company starts spending its own capital on something completely outside its core business, it's not doing that for fun. Nobody wakes up excited to be in the power generation business if they don't have to be. Tech companies are supposed to be great at software, at chips, at scaling fast and light. The fact that some of the biggest, richest companies on the planet are now willing to get their hands dirty building physical power infrastructure, an entirely different kind of business with entirely different risks, tells you just how serious this constraint actually is. That's not a side project. That's a company telling you, without saying it directly, exactly where they think the real bottleneck sits. And here's the part that most people watching this still haven't connected. The grid we have in this country was not built for this. It was built decades ago for a world where demand grew slowly and predictably, maybe 1% or 2% a year, and utilities could plan around that comfortably for decades at a time. The transformers, the substations, the transmission lines, all of that takes years to build, sometimes 3, 4, 5 years, just to get the heavy equipment, because there's a backlog that built up over years of slow, steady demand and not much reason to expand capacity quickly. You cannot rush a transformer the way you can rush a chip order. Nvidia can, in theory, build more factories and make more chips faster if the demand is there. And that's exactly what happened. You cannot build a new power plant or upgrade an entire regional grid in 6 months, no matter how much money you throw at it. Money solves a lot of problems. It does not solve a 5-year manufacturing backlog on heavy industrial equipment that only a handful of companies on Earth even know how to make. That mismatch, explosive demand on one side, slow-moving physical infrastructure on the other, that is exactly the kind of gap that creates enormous multi-year investment opportunities. I've been doing this a long time, and when I see a gap like that between what's needed and what physically exists, that's when I pay attention, because that gap has to close somehow, and somebody gets paid to close it. Every business I've ever built or invested in that actually worked out came down to some version of the same question. What does the world need that it currently cannot get enough of? Right now, today, the honest answer is not a smarter chatbot. It's electricity, boring, unsexy, absolutely essential electricity. So why is this bigger than a single chip company? Even one as dominant as Nvidia has been, because this isn't one company's story. It's not one product. It's the entire physical backbone underneath every AI company that exists or will ever exist. Nvidia sells a product that competitors are racing to challenge right now, and eventually, some of them probably will get closer. That's how technology always goes. But there is no clever engineering shortcut around the laws of physics. You cannot software update your way out of not having enough electricity. Every single AI company, whether it's the ones you've heard of or the ones that don't exist yet, needs power to even turn the lights on, let alone run a training cluster. That means this bottleneck touches every part of the AI economy at once, not just one slice of it. Think about it like this. If you're picking a single company in a fast-moving race, you're betting on that company staying ahead of everyone chasing it. That's a real risk, and it's why stocks like that can be volatile even when the underlying story is right. A better product can come along, a cheaper competitor can come along, pricing power can erode faster than anyone expects. But if you're betting on the actual electricity, the actual copper wire, the actual turbines and transformers and power plants that every single competitor in that race needs, no matter who wins, you've removed a huge chunk of that risk. It doesn't matter which AI lab wins. It doesn't matter which chipmaker wins. It doesn't even matter, honestly, if some brand new approach to AI comes along that needs a fraction of the compute we use today. As long as the industry keeps growing in any form, it still needs power to run on. They all need somewhere to plug in. That's what makes this different from just chasing the next hot chip stock. You're betting on the toll road, not the cars driving on it. And toll roads get paid no matter which car wins the race. I want to say this plainly because I think it gets lost. This isn't a trade you make instead of the AI trade. It's not an alternative bet against Nvidia or Palantir or anyone else doing well in this space. It's the trade underneath all of it. It's the layer that has to work for any of the rest of it to keep working. If you already own AI-related names, this is less about replacing them and more about rounding out what you own. So you're not entirely dependent on one narrow slice of the story staying exactly the way it looks today. And I want to be clear about the scale here, because people hear electricity and their eyes glaze over. They think it sounds boring compared to AI. It's the opposite of boring. Multiple credible energy forecasts now expect data center electricity demand to roughly double, some say more than double, by the end of this decade. And that is an enormous amount of new generation and new grid capacity that has to get built in a very short window. Historically speaking, whole industries that were flat or slowly declining for years, things like nuclear power, natural gas turbines, grid equipment manufacturing, are suddenly looking at demand curves they haven't seen in decades. Some nuclear plants that were scheduled to shut down are instead getting restarted specifically because a tech company wants to buy the power directly. That's not a small trend. That's a fundamental repricing of an entire sector that most investors haven't been paying attention to because it doesn't have the word AI stapled to the front of it. So who actually gets paid as this plays out? I'm going to give you the categories, not a stock pick, because I want you thinking about this the right way. Not just chasing a ticker you heard on a video. First, the utility companies and independent power producers that are locking in long-term contracts to sell electricity directly to these data center operators. Second, the companies that build the actual physical equipment, the transformers, the switchgear, the high voltage cabling, because there's a years-long backlog on that equipment right now, and whoever makes it has a pricing power they haven't had in a generation. Third, natural gas turbine manufacturers, because gas is the fastest thing you can build right now to add power to the grid while everything else catches up. And there are only a small handful of companies on Earth that make those turbines at scale. Fourth, and this one surprises people, nuclear power. Existing nuclear plants are being treated like gold because they're already built, already running, and produce steady, reliable power around the clock, which is exactly what a data center needs. And fifth, the companies that actually build and operate the data center campuses themselves, the real estate and infrastructure side of this, because land near power and water is becoming genuinely scarce in the places that matter. Let me give you a sense of the scale of the backlog too, because this is the part that actually convinced me this isn't just a talking point. The equipment that utilities need to expand the grid, the big transformers especially, has lead times measured in years now, not months. Some of the largest ones can take 3 to 5 years to get delivered from the time you order them. That's not a supply chain hiccup that clears up next quarter. That's a structural shortage that took years to build up and will take years to unwind. And it means whoever is already in the business of making that equipment has more pricing power and more visibility into future demand than they've had in a very long time. When you find an industry where the people who supply the equipment are effectively sold out years in advance, that's usually a very good sign for the people who own those businesses. Now, I'm not going to sit here and tell you this is a sure thing, because nothing is. And anyone who tells you otherwise is trying to sell you something. Ironically enough, let's talk about what could actually go wrong. Because I've made enough bad calls in my life to know you always want to hear the other side before you put real money down. The biggest risk here is timing. Infrastructure investments like this can take years to pay off, and the market is impatient. You could be completely right about the trend and still watch a stock go sideways or even down for a stretch while the fact actual build-out catches up to the story. That is not a hypothetical. That's just how these cycles usually work. The second risk is that AI demand itself could slow down. If the AI build-out cools off, if companies pull back capital spending, some of that projected electricity demand simply doesn't materialize on the timeline everyone's expecting. And that changes the math on all of this. The third risk, and this is the one I think about most, is that some of these stocks have already started moving because more people are catching on to this story than you might think. This isn't some secret nobody's talking about anymore. It's not as early as it was even a year ago. That doesn't mean it's over. These build-outs take a decade or more to fully play out. But it does mean you need to be smart about what you're paying for, not just excited about the story. And honestly, the fourth risk is regulatory power grids are heavily regulated and permitting delays. Local opposition to new power plants near communities and policy changes can all slow this down in ways that have nothing to do with whether the AI story itself is real. There's a fifth risk too, and I almost didn't mention it, but I think it's worth being honest about. Some of these opportunities live inside big diversified companies where the power business is just one part of a much larger, more boring whole that can actually work in your favor because it's more stable, but it also means you're not getting a pure concentrated bet on the trend, that you're getting it mixed in with a bunch of other stuff that has nothing to do with AI at all. You need to actually understand the mix of what you're buying, not just see the word power or energy attached to a stock and assume it's automatically part of this story. Plenty of energy companies have almost nothing to do with data centers. Do the work to know the difference. So here's my honest read on all of this. And I mean honest, not the polished version. I think the chip trade isn't dead. Not even close. But it's matured. It's understood now. Everybody's got an opinion on Nvidia at this point, which usually means most of the easy money's already been made by somebody. The power trade feels like where the chip trade was a couple years back, still underestimated by most of the market, still getting treated like some boring side story instead of the actual thing that determines how fast any of this can scale. I've watched enough of these cycles to know the unglamorous, physical, hard-to-build stuff is usually where the real money sits the longest, because it takes real capital and real years to compete with, not just a clever idea and a good slide deck. That's exactly why the crowd doesn't chase it the way they chase flashy software names. And that's exactly why it's still sitting there at a reasonable price if you're willing to actually do the homework and be patient about it. And look, I know some of you watching this are going to feel like you're always the last one to hear about these things. I want to push back on that a little, because I don't think this one is late. Not yet. Big structural shifts like this don't play out in a month or a quarter. They play out over years, sometimes over most of a decade, in waves. The chip trade itself took years to fully play out, and there were multiple points along the way where people said it was too late, right? Before it kept running, power and grid infrastructure is, if anything, an even longer cycle than that, because you're talking about physical construction, permitting, and equipment manufacturing, not just writing better code. That doesn't mean you should rush in blindly, but it does mean the window here is almost certainly measured in years, not weeks. And there's a real difference between being early and being too late. Right now, I think we're still early. Here's what I actually want you to do. And this is me being real with you, not just wrapping things up. Don't take my word for any of this. Not from me, not from anybody else yelling about stocks on the internet, including the guys with the flashy thumbnails promising you the next 100 baggers. Go pull up the last few earnings calls from the big tech companies building these data centers yourself and just search the transcript for how many times the word power or electricity shows up. A couple years ago, it barely got a mention, almost an afterthought. Now it's front and center on nearly every single one of them. Sometimes it's half the call. That alone tells you where the real constraint is sitting right now. Straight from the people actually building this stuff, not from some guy on YouTube. Do your own homework on the utility and infrastructure companies signing these long-term power deals. Understand what you're actually buying before you buy it, not just the story attached to it. Think in years, not weeks, because that's genuinely how long this plays out. I built real companies from nothing, and I've also made plenty of expensive, embarrassing mistakes chasing a hot story instead of understanding what I was actually putting my money into. Don't repeat that mistake here just because I made it sound exciting. This isn't about being first to the party. It's about actually understanding what's happening under the hood before the rest of the room figures it out. Do the work, take your time, don't rush it. And I'll see you in the next one.